All right, let's talk about one of the most famous signals in a trader's playbook, the shooting star candlestick. We're going to break down what this thing is really telling you, and more importantly, how you can actually use it.
You know the feeling, right? You're in a great trade, it's just going up and up, profits are looking fantastic, but then that little voice in your head starts to whisper, okay, is this it? Is this the top? Because if you get out too soon, you leave money on the table. But man, if you get out too late, that can hurt even more.
Well, that's where something like a shooting star comes in. Think of it like a warning flare lighting up the sky at the peak of a rally. It's what we call a bearish reversal pattern, and all that really means is it's a hint that the upward momentum might be gassing out, and the sellers, they're starting to wake up and take over.
Okay, so let's get into the weeds here. To really get what this signal is saying, we've got to dissect what a shooting star actually looks like. Every part of it tells a piece of a story about a battle that happened in a single day of trading.
So, for a candle to be a real shooting star, it has to check a few very specific boxes. First, and this is non-negotiable, it has to show up after a nice, strong uptrend. Then, you look at the body of the candle. It's tiny, meaning the open and close price were super close together. But the real star of the show is that crazy long upper tail, or wick. It needs to be at least double the size of that little body. And last, there's almost no shadow sticking out of the bottom.
So what's the psychology here? What's the story this candle is telling us? Well, during the trading day, the buyers, the bulls, were totally in charge. They pushed the price way, way up, creating that long wick. But then, the sellers, the bears, showed up with a vengeance. They didn't just stop the price from going higher, they slammed it all the way back down to close near where it started. It's like a picture of pure buyer exhaustion.
Now, here's a subtle but really key detail. The color of the candle's body matters. If it's red, it means the sellers were so strong they actually pushed the price to close below where it opened. That's a much stronger, much more bearish signal. If it's green, the close was still a little bit higher than the open. It's still a warning sign for sure, but that red candle, that shows the sellers really won the day, hands down.
And this is where a lot of people get tripped up. The shooting star has an identical twin. It's called the inverted hammer, and it looks exactly the same. So what's the difference? It's all about the context. A shooting star happens after an uptrend and signals a potential drop. The inverted hammer happens after a downtrend and signals a potential bounce. Same shape, completely opposite meanings. It all comes down to what was happening before the candle appeared.
All right, so you can spot the pattern. Big deal, right? The real question is, what do you do with it? How do you actually trade it? Let's build a simple, practical, three-step plan to go from just seeing the signal to actually making a move. We're going to keep this really simple. Step 1, you identify a valid pattern. Step 2, and this is probably the most important part, you confirm the signal. And then step 3, once you've got that confirmation, you act. Let's break them down.
So for step 1, you need to put on your detective hat. First, is there a clear uptrend leading into this? Check. Second, did this candle pop up at or very near a recent high point? Check. And finally, does the shape fit our rules? Small body, long upper wick, little to no lower wick. Check. If you can't say yes to all three, it's not a true shooting star, and you move on.
Okay, step 2 is all about one thing, patience. You never, ever trade this pattern by itself. A true confirmation, the gold standard, is when the next candle closes below the lowest point of the shooting star. That's the market basically saying, yep, that signal was for real. You can also look for other clues, like a spike in trading volume on the day the shooting star formed. That adds a lot of weight to the signal.
And finally, step 3 is where the rubber meets the road. Once you get that confirmation candle, you might consider taking a short position. But, and this is crucial, you have to manage your risk. A really common strategy is to put your stop loss just a little bit above the very top of that shooting star's long wick. That's your escape hatch if you're wrong. For a profit target, you could aim for an old support level or just a simple risk-reward of say 2 to 1.
Okay, now it's time for a little reality check, because no pattern, absolutely none, is perfect. The shooting star can and will fail you sometimes. So understanding its limits and the common mistakes people make is just as important as knowing how to spot it in the first place.
So, just how reliable is this thing? Well, studies suggest that when a shooting star is properly identified and confirmed, it works out about 65 to 70% of the time. Now that sounds pretty good, right? But let's flip that number over and see what it really means.
Because it also means that about 1 out of every 3 times, it's a fake out. The pattern fails. The uptrend just keeps on chugging higher, and anyone who went short just got stopped out for a loss. That is a huge failure rate, and it's exactly why risk management isn't just a suggestion, it's mandatory.
And you can really see it here. Yeah, the success bar is bigger, but that false signal bar is really substantial. You just have to go into it knowing that a third of the time, it's not going to work. Your trading plan has to survive that 35% failure rate. So here are the big mistakes people make. Number one, hands down, is jumping the gun and trading before you get confirmation. Another huge one is ignoring the bigger picture. If the market is in a screaming hot bull run, one little bearish candle might just be a speed bump. And of course, not using a stop loss. That's just a recipe for blowing up your account. Remember, it's just one candle. It's one piece of a much larger puzzle.
And speaking of the bigger picture, the usefulness of this pattern changes a lot depending on the context. Specifically, what kind of market you're looking at, and just as important, what time frame you're trading on.
So check out these numbers. On a daily chart, the reliability is up there, around 70%. But as you start looking at shorter and shorter time frames, look what happens. It drops. Down on a 15-minute chart, you're looking at something that's barely better than a coin flip. Why is that? It's because the shorter the time frame, the more random noise there is in the market. A pattern like this just carries so much more significance on a daily or even a weekly chart. If you only remember one thing from all this, let it be this right here. The pattern is a warning. It is not a guarantee. It's a flashing yellow light telling you to slow down and pay very close attention. It is not a red light telling you to slam on the brakes and sell everything. So in the end, the real value here isn't in the pattern itself. It's in how you use it as part of a complete trading strategy, a strategy that demands confirmation, that respects risk, and that always considers the broader market context. So the real question for you to think about is this: is the shooting star going to be a key part of your strategy, or is it just another piece of market noise?